It's a precarious time in the journey toward economic equilibrium. As we traverse the uncharted waters of post-pandemic recovery, central banks around the world are grappling with the delicate task of navigating between the Scylla of stubborn inflation and the Charybdis of economic stagnation. In the United States, all eyes are on the Federal Reserve as it prepares to unveil its latest interest rate projections. Like a seasoned mariner studying the stars, investors will scrutinize these economic celestial charts, seeking clues about the central bank's resolve to chart a course back to the halcyon shores of price stability. The Fed, under the steadfast leadership of Chair Jerome Powell, has maintained a stoic determination, holding borrowing costs at their loftiest levels in 2 decades. Yet the eternal quandary persists: how many more rate cuts, if any, will be required to tame the inflationary beast without capsizing the ship of economic growth? In the great tradition of American pragmatism, the Fed's policymakers find themselves torn between the siren calls of opposing economic theorems. A chorus of economists expects a decisive signal of 2 rate cuts, while an equally formidable contingent foresees a more cautious approach, with 1 cut or none at all. The specter of inflation, that relentless scourge of economic tranquility, looms large. The Fed's preferred measure reveals prices rose 2.7% in the year through April, a stubbornly elevated figure that exceeds the central bank's 2% target, a target that has become a modern-day economic holy grail. Yet even as this inflationary hydra rears its many heads, the labor market surges with Herculean vigor, adding jobs and propelling wages ever higher. It is a paradox that would confound even the most learned of economic philosophers. Thomas Simons, a sage economist at Jefferies, counsels patience. The Fed will opt to keep rates steady for longer. They will want to see a renewed run of more favorable data in line with an inflation trend closer to 2% before they feel comfortable cutting rates. Across the northern border, in the Dominion of Canada, Governor Tiff Macklem of the Bank of Canada will take to the podium in Montreal, fresh from his daring foray into the uncharted territory of an easing cycle. A lone pioneer in the group of 7, he will undoubtedly face a barrage of queries from the economic cognoscenti. To the east, the old world beckons, its ancient capitals humming with the buzz of economic discourse. In the United Kingdom, the clamor of an election campaign provides a discordant backdrop to the release of crucial wage numbers and GDP data, portending a potential inflection point in the Bank of England's own Odyssey. Across the Channel, the European Central Bank's Christine Lagarde and her cadre of governors will undoubtedly face interrogation in the wake of their recent rate cut, their words carrying the weight of prophecy for the continent's economic future. Farther afield, in the distant realms of the East, the Bank of Japan prepares for a pivotal decision that could reverberate through global markets. Whispers of reduced bond purchases have set the financial avenues of Tokyo aquiver, hinting at a potential shift in the tectonic plates of Japanese monetary policy. To the south, the sands of Saudi Arabia bear witness to an economic contraction, as the kingdom grapples with the vicissitudes of the oil market. Yet even in this arid landscape, the tender shoots of a diversifying economy offer hope for a more verdant future. In Africa, from the bustling streets of Nairobi to the dusty villages of the interior, all eyes turn to the budget unveiling of Treasury Secretary Njuguna Ndung'u. His words will carry the weight of a nation's aspirations, as Kenya charts a course toward fiscal rectitude and relief from the specter of debt distress. And in Latin America, the economic barometer swings wildly, from the inflation-battered shores of Argentina to the cautious optimism of Peru, where the indefatigable Julio Velarde, one of the world's longest-serving central bankers, has finally restored consumer prices to their sacrosanct 2% target. It is a kaleidoscopic tapestry of economic narratives, woven from the threads of data, policy decisions, and the indomitable human spirit's quest for prosperity. As we navigate these choppy waters, the siren song of stability beckons, a lodestar to guide us through the turbulent seas of global finance. For in the end, the Odyssey toward economic equilibrium is a perpetual voyage, its course ever shifting, its destination forever receding over the horizon. It is a journey defined not by arrival, but by the steadfast determination to stay the course, to trim the sails of monetary policy with a deft and judicious hand, and to weather the storms that inevitably arise. And so we press on, economic argonauts all, our eyes fixed upon the eternal pursuit of that most elusive of prizes, the golden fleece of financial tranquility.